In the midst of a tumultuous market, what's a stock trader to do to navigate it? Well, our chief equity strategist and economist John Blank says, whatever you do, don't fight the Fed. John, what does that mean?
Well, Terry, that's a traditional statement that has been made for decades. And that it really needs to be enhanced as opposed to de-emphasized now, because the Fed is now taking a $3 trillion with a T money printing exercise over the last 3 or 4 months, and it's basically taken its balance sheet and doubled it. And we've not seen this before 2009. We did start to see this in 2009. We saw another trillion then. We saw 2 trillion in 2012. Now we're at 3. 1, 2, 3. So this is the story. Don't fight the Fed used to be about them raising or lowering interest rates. And when they were stimulating the economy, you want to be in stocks. What this new version of Don't Fight the Fed is don't fight the money printing. Don't fight the bond market suppression. Don't fight the 10-year treasury at 0.8%. That leaves nothing but air and light for stock investors, Terry, and that's what we're seeing in this market.
Well, you and I are talking here on the 25th of June. Yesterday, the 24th, the market had a down day. But prior to that, we had recovered nearly all of the stock losses due to COVID-19. So how long will the Fed keep supporting the market? And is it really necessary anymore?
They're going to support it well into 2021, probably the end of 2021. They don't even have any rate hikes in the dot plots until then, Terry, which is consistent also with the money printing. They can always go back to the Treasury and get another round here. We do have another stimulus bill in the works, probably will land before the election, and the Fed will certainly be talking to the Treasury about their elements of need in that new bill. So generally speaking, I think, we're seeing a market that's going to sideways trade on the resurgence of COVID-19 infections in the United States. But looking beyond January, when it's almost certain also that we'll have a vaccine, the markets will look beyond January to that vaccine. And as we roll towards the end of the year, that gives you just a clean Fed money printing story without the COVID, and that's probably taking us up.
The stock rally, John, comes with less than rosy economic data out there. Is there a disconnect that is a bit troubling?
Well, Terry, I just went through a TV show this week about 3 stocks that just completely blew up: a food retail stock, a chicken stock, and a cloud computing server stock. All these are showing signs of what's going to happen here. Number one, until there's a vaccine, a lot of CEOs and a lot of consumers are just simply not willing to play ball in some areas of this economy. And that's going to be the bear case for at least 6 months. The problem with that is layered into it is a bull case of a vaccine and getting things back to normal the way things were before the COVID situation. So this is the multi-layered, many-layered story of this market. And yes, at the top line of indexes, we're seeing no connect to the economy, but within stocks themselves, where the stories are specific to existing businesses, where we can see the subtleties of the COVID situations play out, there is no disconnect. The big stocks that they're making look disconnected.
So is there something specific that you can point to that is going to provide this market with more upward momentum going forward, so investors can have less anxiety over more market volatility, a second wave of coronavirus, and geopolitical tensions all put together?
It's this virus vaccine, Terry. I think you've got at least probably dozens of candidates out there. There are multi trials out there. And the issue isn't the virus vaccine per se. It's the efficacy of the distribution of whatever comes out of that pipeline and the speed with which it gets to market and the embrace with which people take it up. But at the end of the day, before the vaccine, the other thing is a better acceptance in the American dialogue about mask wearing in public places. We've got to get our arms around the idea that this is our obligation to each other and our obligation, frankly, to our economy to do so.
So meantime, are stocks more vulnerable to negative catalysts?
They are, Terry. I think I'm not negative right now because of this Fed support, but I am neutral right now because the headwinds and the tailwinds, the headwind being the COVID situation and the weak economy, and the tailwind being the Fed, are kind of leaving us in a range trading environment for at least a few months. And I think people should get used to that.
What could those catalysts be at this point, though?
At the end of the day, Terry, it's going to be analysts in a granular way across a bunch of companies who start to notice progress in the economy. And that will then percolate up into top line assessments that get upgraded. We're seeing some of that already in bottoms up EPS estimates for Q3, where they are going up a bit. And that just needs to keep happening.
Has liquidity and support provided by the Fed caused a little too much investor optimism?
No, I don't think so. Because again, what the Fed is doing is putting a tailwind in place until the vaccine comes in. And then the vaccine is quite bullish. So you have a 1-2 punch. I think the real issue here, people keep thinking, is the Fed is going to pull back its stimulus, and this whole balance sheet fixed income experiment is going to go away. And the answer is it's in the next 5 to 10 years, the Fed is not going away from fixed income support. And this is just a fact. The markets and Wall Street have become addicted to it, and there's just no way they can pull back. So the idea really is a kind of a one-sided one, that the Fed just stays in the game.
Well, you say the U.S. companies to watch for 2020 earnings and revenue growth catalysts are solid growth ranked major companies in a variety of consumer spaces. What story does that tell?
Yeah, let's talk, things like, used car, people buying used cars, people buying boats to get outside, recreation homes. I mean, we've got all kinds of ways that the consumer, a pent-up demand consumer, one that's restless from sitting around his house, is showing up and doing actually quite a lot of spending. So I think you're seeing shifts away, and we'll start to understand that better as time goes on.
Also regarding stocks, as more reopened sectors gain traction here, here's a few stocks specifically that you're looking at: Sempra Energy, Fortinet, and AbbVie.
Yeah, let's talk these three out. Okay, so I've got these stocks, and Sempra Energy is out in California. This is ticker SRE. This is a utility stock, and so as California's electric use goes up, and it's going to go up, and it is going up, this stock looks great. Fortinet, FTNT, large correct trader always owned this at various times. It's a great stock. You can't beat this it's a cloud security stock, so everybody's online. I don't necessarily think it's cheap right now. I might wait for a pullback and a tech pullback, but Fortinet has to be on your watch list. And the third one's AbbVie, which is a big Chicago-based drug stock. They've had some patent expirations out there on some of the major drugs that worried the market, so they went ahead and bought somebody, and they bought a very big player, Allergan, and they're going to merge that in. They have done the deal in May, and they're continuing to build it out. And that's really pushing the earning estimates up. So these three stocks, Sempra Energy, Fortinet, and AbbVie, show you the way forward on this market.
All right, Chief Equity Strategist and Economist John Blank's advice: don't fight the Fed. They can see what you see, but they're first in these days. John, I'm Terry Ruppolo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.